right, welcome to the Multifamily Investor Nation webinar series. This is going to be a webinar that we're going to be talking about key principles, sponsors, and then even like comparing that to maybe what a loan guarantor is specifically for apartment syndication. But this can also kind of translate over into other areas as well. And so, you can, when I say other areas, it's not specific to, just real estate, if you will. It could be other areas such as, other types of real estate or even other businesses, right? But specifically, we're going to be talking about apartment syndication here and being a little bit more specific about that as well. So let me see here. I'm going to open up my Q&A box as well in case there's any questions throughout the webinar. Looks like we have a good group here on the webinar. This is always a topic that is very popular and a lot of people kind of misunderstand it, especially people who are getting into the space. But one of the first things before we get started that I want to mention to you is I'm Dan Handford. I'm actually one of the managing partners of a group called PassiveInvesting.com. And if you actually go to PassiveInvesting.com, and you can see that right here on my screen. If you go to PassiveInvesting.com and you go to Meet the Team at the top here, you can actually see our team here. This is actually me, Dan Handford. And if you want to click on that, you can find some more information about me and my bio. You can also click on this LinkedIn button here to connect with me further on LinkedIn. So you can certainly do that as well. And of course, the rest of our team here, the different managing partners with the various businesses that we have, as well as the rest of our team is listed underneath there. So you can certainly scroll through and see that. It's not our entire team. It's primarily just our directors and administrators that are part of our group that are listed here on the page. So you can go through there and peruse that. But I don't want to spend too much time going over myself and my background because I know you guys hear from us and our team on a regular basis. And so I want to dive into this topic here. And then one last thing I was going to mention to you is about our new book. It was released in the fall of last year of 2023, and it's called Apartment Syndication, the Ultimate Guide for the Active or Passive Investor. And so for those of you who are joining us live, there's a link that just popped up into your webinar chat there. You can certainly click on that. We'd love for you to grab a copy of that and also post a review for us. But this book was specifically written because there's a lot of gurus and teachers out there that are, of course, writing a book to charge you money for their webinars or not their webinars, but for their masterminds or for their coaching programs. And we don't do a coaching program, so we don't have a paid sponsorship program or coaching program or mastermind or anything like that we're trying to sell you in this book. This book is purely designed to be able to teach you the ins and outs from A to Z if you're an active investor or a passive investor on everything about apartment syndication. Basically, Danny and I, as well as our former managing partner, Brandon Abbott, got together and wrote each one of these chapters out specifically, and to really teach you how to run the apartment syndication business as a true business. So if somebody tries to tell you that apartment syndication is just easy, then you should probably run the other way, because it is not an easy business to get into. It's not very, I say it's not easy, but it's also not hard in itself. But what makes it more challenging and what makes it hard and not easy is that it's very complex, right? So there's multiple parts to it, and all the different individual parts are not hard, but when you put them all together, it makes it very complex and very challenging. And when you are taking money from another person and a passive investor, and you're putting it into your business, that's a big, huge responsibility, and you should not take it lightly, and you should not run this as just a side hobby or something you do for fun. This should be something that you run as a true business, and that's really what this guide was designed and written for, is just for you to learn how to run apartment syndication as a business. And then as a passive investor, it teaches you specifically how to look at apartment syndication, how the people that you're investing with should look at apartment syndication. It also has in there some red flags for investing with apartment syndication, things to look for, things to ask sponsors, and kind of the best ways to kind of diversify the portfolio when it comes to real estate and apartment syndication. So make sure you go there. You can go to just multifamilyinvestornation.com, and that's where this is listed at the very top. You can click on get your copy on Amazon there, and you can certainly do that. I actually spent about 12 hours in a studio recording the Audible version of this book. So we do also have an Audible version of this book. We have the ebook or the Kindle version of this book, and then we also have the printed copy of the book as well. So I would love for you to be able to grab a copy of that book and learn a lot more about a lot of the topics that we cover on a weekly basis. And I might even have a copy of it over here. So let me grab this real quick. Here's actually a copy of the book right here. So I forgot that I had that book over on my bookshelf there on my little table in between my chairs. So anyway, all right, let's dive into this topic about the key principle and sponsor. We're going to spend about probably 20 minutes, 25 minutes going over this topic. And if you have questions throughout, keep those questions to the end. So I'm going to answer as many questions as possible towards the end. And so obviously, if you have questions as I'm going throughout, I suggest that you write them down first instead of typing into the chat box or the Q&A box, because I may answer your question as we get towards the rest of the material. But feel free to ask as many questions as you want as we get towards the end there, and we'll be able to answer as many of those as we can. So let me see here. I'm going to pull this up. I'm going to lower everybody's hand right now just because we are good to go from that perspective. All right. So first question here is this first one. What is a key principle / sponsor, and how does that compare to a loan guarantor? So the two words that are somewhat synonymous are key principle or sponsor, right? And I say it's somewhat similar or comparable to each other is because a sponsor is really somebody who is putting together the apartment syndication offering, right? So it could be one person, it could be three people, it could be, five people, right? But it's the group that is putting together the offering to be able to present to their investors. That is the sponsor. Now, typically a sponsor will have a key principal that is the person who is the primary person that allows you to be able to put that deal together, right? Now, the key principal is actually more synonymous with a loan guarantor. So a key principal and a loan guarantor are more synonymous with each other than an actual a sponsor itself, because a sponsor could be just a sponsor, but not the key principal and not a loan guarantor. Now, obviously, a loan guarantor is somebody that has the financial ability to be able to sign on the loan, right? Now, there with the key principle, if you think about it this way, in order to open the door for apartment syndication, you must have a key principal that can put the key in, right, and unlock the door so you can actually have the offering available. But if you're new to the business and you don't have a lot of experience, you don't have a lot of financial net worth or liquidity, then you will likely not be able to be a key principal or a loan guarantor. So let's talk about the loan guarantor for a minute. The loan guarantor is somebody who has at least a net worth of the loan balance. So if you're buying a property that's, $15 million, and let's just say you're putting $10 million in debt on it, that means you need to have at least $10 million in net worth. You also have to have liquidity. The liquidity must be at least 10% of the loan balance. So the loan balance is $10 million. You must have a net worth of $10 million, and you must have a liquidity amount of at least $1 million. So those are the two primary things that you must have. Now, the third component is also important. So even if you have the net worth and the liquidity, if you don't have any experience, then you might also have a challenge trying to get that loan. Now, if you're trying to get a $10 million loan and you have a $100 million or a $500 million net worth, they're going to probably look the other way on the experience level side of things, potentially, right? Not all lenders are the same, but typically they're going to want to see three things: net worth, liquidity, and experience. You must have all three of those things. Now, it is possible to to have multiple key principles. So think about it this way. Let's say you have somebody who has the net worth, but no liquidity and no experience. Well, that's one key principle. And then you have another person that doesn't have a very high net worth, but they have the liquidity necessary that you need, but they don't have experience. That could be the second key. But then maybe you have somebody that does not have the net worth or the liquidity, but they come to the table with the experience. Now you meet those three things. So not one individual person has to have all three of those things, but your team must have all three of those things in one. Now, that doesn't mean that you have to have because you can even have more than that in the number of key principles. Because if you need 5 million or if you need $10 million in net worth, but you have two people that have $5 million a piece in net worth, you could actually combine those two and have a $5 million person in net worth and another person with 5 million. Now you meet that $10 million. Now you have two key principles that are helping you meet that net worth requirement, right? And so there's a lot of different ways to kind of, parcel this up, but ideally it's best to try to just have one person that meets, at least the majority of those things, two of those three, or potentially three of those things, right? To be able to help you along the way. Not only does this help you from a loan perspective, but also helps you from mitigating any types of downside risks. So you have somebody that actually has experience that's on your team that actually knows what they're doing, right? And they can say yes to that deal or no to that deal to make sure that you don't get yourself into a deal that is not so good, right? All right. So the next, somebody had a question here about, are you saying 1 million or 10%? So if the loan balance is $10 million, 10% of the $10 million is $1 million. So if those two things that they must have is the net worth of the loan balance. So your loan balance is 10 million, then you also have to have 10% liquidity of the loan balance. So if your loan balance is 10 million, your liquidity requirement is now 1 million. And that has to be maintained throughout the life of the loan. If you drop below that, then you could be in default of the loan covenants, depending on the lender, right? And there may be some, curing periods and things like that are available, but typically they want to see at least a liquidity amount of 10% of the loan balance. All right. The next topic here we wanted to talk about is how much of the partnership should you give to the key principal or sponsor? So, and this really comes up when maybe you and your buddy have gone together and you wanted to start an apartment syndication business. You both have maybe some experience running these different types of multifamily properties or doing construction or development, or you have some form of business background and experience, right? And you want to go and buy an apartment complex, but you don't have the necessary requirements to be able to sign on the loan because maybe you don't have the net worth or the liquidity, right? Well, you might have to bring on a loan guarantor that has a loan balance. You have to bring a loan guarantor in that has that net worth and liquidity requirement, right? And so when you have that net worth, that person, if you need that person, then they're going to want to get paid, right? And so as far as the partnership is concerned, it depends on the deal itself and how much you are willing to give up, and also how much they're willing to support you in that, right? If it's somebody that's just coming in saying, hey, you can use my balance sheet and I don't really care, I don't want to look at things, then they may only ask for 5-10% of the GP, right? But if they're going to come in and maybe bring some investors and continue to help you with asset management and continue to guide and direct you, which I think is the best scenario, then they're going to probably want a little bit more, maybe 20, 30, or 40%, right? And it's worth it to you as you're getting started to have that person that's really good be able to come alongside you and actually help guide and direct you so that you don't make some huge mistakes down the road, or at least try to mitigate some of those risks of that potential downside. So of that, how much of that general partnership should you give? It really depends on the negotiation, but if they're just coming in to give their balance sheet, it's a small, maybe 5-10%. If they are going to be doing some more with you, bringing some investors, it could be 20, 30, 40%, maybe even 50%. But again, these first couple of deals as you're getting started, it would be good for you to be able to have somebody like that in your back pocket, even if you had to give them a little bit more of the GP to get started, because then down the line, once you build your net worth and your liquidity and your experience level, you might not need them as much anymore, and you can start to reduce that or eliminate that person completely so you can just do it on your own. Now, there is typically a guarantor fee that you would be paying to the loan guarantor, right? So the loan guarantor is the person who is bringing that balance sheet that they can actually, so that they have the net worth and the liquidity. Typically, the loan guarantor fee is going to be anywhere between like 1 to 3% of the loan balance. So whatever that loan balance is, you're going to give them that 1 to 3% as like almost like an acquisition fee, right? So this person, if they're going to be on the general partnership at say 20%, and they're going to also get a guarantor fee. They're going to get that guarantor fee paid at closing, 1 to 3% of the loan balance. And then they would also share in the acquisition fee because they're going to own a portion of the GP. So whatever that acquisition fee is, they would get that kind of 20, 30, 40% of that, depending on how much they actually were provided of the general partnership based on the amount of efforts that they're bringing to the table. Now, what are the risks for the key principal and the sponsor? So why are you paying this loan guarantor fee? Obviously, why you're giving them the general partnership information stuff, because you couldn't do the deal without it, right? Well, the guarantor fee is really helping because it is actually a very risky situation for a loan guarantor to put up their balance sheet to be able to sign on the loan, right? Because if that loan goes into default, then that person with that balance sheet is going to have a hard time in the future signing on any other loans, and unless like a number of years passed, or maybe they have 50 loans and only one of them defaults, it probably wouldn't be as big of an issue, right? But if they only have a few of these loans, and one of them defaults or two or three of them defaults, it could be a very a risky situation for them, because they could potentially come after them if there is any type of recourse involved, if it's a recourse loan. If it is a non-recourse loan, there's still risks there, right? Because if they're not managing that deal on a daily basis, and they don't 100% trust you, and you end up maybe doing something that would cause the bad boy carve outs to be kind of activated, if you will, then they could come after the loan guarantor for any difference between any sale of the property and the loan balance itself, if they're not able to get that money out of the sale. So there is potential risk there for the loan guarantor, so that you have to be that loan guarantor has to be very careful to make sure that they don't sign on too many of these loans with people they don't really know, right? Now, what are the risks for you as a sponsor? Well, if I'm a key principal or a loan guarantor, those are kind of synonymous with your project, then I'm going to want you to also be a loan guarantor, right? And the reason why is because I want you to be on the hook if something goes wrong with your deal, not just me. So you're going to have to sign on the loan, and that's of course going to help you because it'll give you that experience necessary of signing on loans, but it'll also make sure that I know that that you could potentially be in a losing position if you don't do things the right way, or if you do things fraudulently or whatever. We're both going to be on the hook, right? So you have to make sure that there's this alignment of interest, not only with the LPs, the limited partners, or the passive investors with the general partnership, but there must be an alignment of interest with all of the GP party. So all people in the general partnership must also be aligned and have that same level of interest involved in each one of these projects, in each one of these deals. Okay. Now, let's talk about this last one here. How to find and select the right key principal or sponsor for your deal. I'm actually just going to go ahead and drop sponsor off of there. I'm just going to talk about the key principal, right? Because that's really what we're talking about here. You're already a sponsor. You're trying to figure out which key principal or principals you need to be able to sign on the loan that allows you to be able to get your deal out to your investors, so you can start raising some money and start earning a return and start getting some return for your investors as well. So how do you find them, right? Well, one of the best things you can do is to go to different events around the country. Might sound crazy, but I'm not going to sign on your loan if I don't know who you are, right? If I haven't met you in person, if I don't know who you are, I'm not going to be taking that risk and signing on your loan, right? And I'm not saying I'm willing to do that, right? I'm not saying I'm willing to sign on your loan right now, but I'm saying if you just meet somebody for the first time and you ask them to be your loan guarantor, chances are they're not going to do that. But if you are showing up at events, you're showing up at even if it's a local loan guarantor, and you show up to RIA events, real estate meetups, conferences, whatever that may be, and they start seeing you and you start interacting with them, you start having lunches and dinners and coffees, and you actually start to build a relationship with them, then you might actually have that person to be able to have as your key principal. And the reason why that's important is people only do business with people that they know, like, and trust. But if they don't know, like, and trust you, then they're never going to have that ability to want to even sign on one of your loans, right? But you might be asking, well, I don't have a deal right now. Well, now is a great time to start building relationships with people who have the potential to be your key principal so that you can have somebody in your back pocket when the time is right for you to be able to have a deal. So go to conferences. There's actually one coming up here in March. Actually, I think it might be in April. It's called the Best Ever Conference. If you have not been to that conference yet, I would highly recommend that you go to this conference. It's actually here on your screen right now. I just found it. It's called the Best Ever Conference. My mentor, Joe Fairless, is the one who actually puts this event on, and it's a great event. I go to it every year. It's actually in Salt Lake City, Utah, April 9th, 10th, 11th, and 12th. I have no benefit for promoting this with you. I'm just sharing it with you because this is a great event. This is one of the highest level events that are out there in the country right now, where a lot of high level real estate investors get together and really talk a lot about real estate. Now, I'm going to be at this conference, so if you're here and you want to meet up with me, we can certainly work that out. But I'll actually be there for pretty much the 10th, 11th, and 12th. I won't be there for the 9th. I'll probably be flying in later in the 9th, but then leaving on the later in the afternoon on the 12th. But what my plan is I'm actually going to be here meeting with a lot of my passive investors and other GPs to potentially create some partnerships, right? Potentially do some things here. Now, for our group, myself and my other partner, Danny Randazzo, we sign on all of our own loans. So we're not looking for loan guarantors or key principals. We already are that for our own group. We've done that from the very beginning, and we've signed on all of our own loans. But this is an event that you can rub shoulders with some really high level people. There's billions and billions and billions of dollars here of assets under management, right? Joe Fairless's group alone has about a little over 2.5 billion. We're at about 1.5 billion ourselves. So there's usually about 1,000 plus people that are there at this conference. I'll actually be on the pitch forum that they're doing. So almost like a Shark Tank for real estate. I'm actually going to be one of the judges, if you will, for that pitch forum. I was there last year and was able to invest in an actual deal. So you can also apply. There's going to be a button right here, apply to pitch your deal on the platform. So you can certainly submit to try to see if your offer can be presented on here. But anyway, I'll stop talking about the Best Ever Conference because I know it's a great conference and you're going to be able to be there. But let's go back to this topic here. How do you find and select the right key principal? Show up, right? You got to show up to conferences. You got to put yourself out there. You have to meet people. You have to actually put faces to the name and continue to build that relationship. Again, don't think you can just show up at the Best Ever Conference and find somebody, and all of a sudden, like the next week, they're going to sign on the loan for you, right? You got to show up to events like this to be able to let people know that, hey, you're still in the game. You're looking for a loan guarantor, build that relationship and see what kind of value you can help provide them and what they're working on. And then you can start to build that relationship to a point where you can find a loan guarantor for one of your future projects that you have and that you put together. So I'm going to pause right now. I'm going to open it up for some questions and answers. I know some of you might actually have some. So I know there's a few of them that have already been typed into the chat box here. So I will read through this and go from there as well. All right. Can the loan guarantor be a passive guarantor? So the answer to that question is yes and no. So most of the time, the lender, one of the other stipulations is that they also want to see that the loan guarantor has some form of skin in the game, right? So not only are they signing on the loan, they also want to see that sponsor or that key principal putting some money up. That guarantor needs to put some money into the deal so that the lender is confident that they actually care about the deal, right? And they want to see that deal succeed. So they're going to usually want to see some form of investment. Every lender is a little bit different as far as how much. Sometimes it's just, $100,000, maybe a couple 100,000, or at least bringing in some significant capital from their own investment group. But they want to see some form of skin in the game. But at that point in time, could they still be passive? They could still be passive. But you really do not want a passive loan guarantor. You want somebody that can continue to monitor things, continue to watch things, and help you and guide you and direct you, because that's what they're there for. Right? They're not just there for their signature. They're not just there for their balance sheet. They're there to help you and guide you and direct you, especially as you're getting started and you're new in the space. So you don't have to pay for a really expensive mentor or anything like that. You can actually just go find and build a relationship with a great loan guarantor and key principal to be able to help and guide you along the way. All right, let's see here. How much would the KP need to invest in the deal? So I guess we already answered that question with that answer there. So typically, it really just depends. But I've seen some lenders say nope, they don't have to put anything in there at all. Obviously a lot of most of the lenders like to see some investment, but even 25 or 50K for some lenders is fine. But it all depends on the size of the deal as well. If you're trying to take down a $50 million loan balance and you're putting in $50,000, that's probably not going to be enough from a loan guarantor perspective to satisfy those lender requirements. So each lender is going to be a little bit different from that perspective, but you definitely want to have that a question with the lender. Now, it will be a little more challenging for you to find a loan guarantor if it is a recourse loan versus a non-recourse loan. Because if it's a recourse loan, that means regardless of what happens, if the deal defaults, they're coming after the loan guarantor for the difference, right? If the loan balance is not satisfied. So they're going to come after you after that loan guarantor. So it is a lot riskier. So maybe a little more challenging to find somebody from that perspective. So most of your apartment syndication deals and your loans will usually be non-recourse, right? So that's nice because it reduces that risk a little bit for the loan guarantor, even though there is still inherent risk there because they still have the potential for those bad boy carve outs to be activated and then still come after that loan guarantor for the difference there. How is the key principal fee dispersed at closing or as equity on the sponsor side? Do they get a piece of the sponsor upside to the KP or guarantor? So yes, so that's what I was saying is like the GP ownership is going to give them that upside potential and that upside spread, right? So if you're giving a key principal or a sponsor 20% of the GP, when you exit that deal in a couple of years or however long down the road, whatever that profit split is, let's say you own 80% of the GP and they own 20%, they're going to get 20% of the profits and you're going to get 80% of the profits of the GP side of the project, right? Because there's two different sides of it, right? There's the LP side and there's the GP side. And those are the two things that are split whenever you sell the project. And so typically they will get both a piece of the GP, whatever's negotiated, usually between about 20 to 40%. And then of course the actual guarantor fee or the key principal fee, however you want to call that fee, it typically is dispersed when you initially buy the asset and you close on it initially. So that money will be raised up front from your investors and it's paid out whenever you close on that project. Again, that helps them because they also have to maintain a certain amount of liquidity throughout the entire throughout the entire time that you have that loan balance at the bank, right? With that lender. All right. Do you recommend wholesaling commercial multifamily apartment deals to start to raise capital for your first deal or to start syndication? Matter of fact, I would actually suggest that you partner with another group that's more experienced first to build your credibility, to build your track record, and it also helps you check that box for the experience requirement, right? Whenever you go to signing on the loan. And now, if you've joined that person, you got a couple of deals under your belt, you've joined the GP on that side of things, you've helped bring in some money, you've helped bring in some asset management duties and some underwriting, things like that. You can now help those other groups that have a little more experience than you, and you can build that experience up as well. That would be the best way to do it because you need to be able to build up your experience and build your credibility, build your track record, not with just the sellers and the brokers, but also with your investors. All right, I got two more questions here, and then we're going to wrap it up. Are most or some loans based on the cash flow of the property or the guarantor? It's the terms of the loan are usually never determined based on the loan guarantor, right? Now, if you don't have a very good loan guarantor that doesn't have the net worth and liquidity, then that may affect the actual proceeds that they'll give you. Because if you don't have enough net worth and you can't find somebody, then they're going to want to bring that back, bring those proceed numbers down. But typically, you're not going to see that. Typically, most assets in the multifamily space are going to be based off of the actual performance of that property more than it is the guarantor themselves, right? So they're going to be based off of the net operating income of that property and the debt yield numbers and the DSCR coverage ratios and things like that. All right. Let's see. Do the guarantors usually have a working relationship with the lending institutions? I find that banks are very slow to react with someone like myself that is new to the game. So if you are a new guarantor to the space, then it is possible that they might not, really give you a lot of attention, if you will. But very rarely will a lender have like a list of guarantors in their back pocket that they're going to start recommending for other people, right? That's not usually how it works. Usually you have to build a relationship with these different groups first. If you want to be a loan guarantor, you have to build relationships with these various groups and know who they are. And then when they have a deal, they call you up and say, hey, we have this deal. We already got the term sheets from the bank. We want you to help us from a net worth, liquidity, and potential and experience side of things to help us take down this loan. So very rarely does that happen. Now, it is possible to be able to get with some of these brokers, mortgage brokers, because some of the mortgage brokers, in order for them to be able to get loans for some people, they need guarantors. So if you reach out to some of these brokers or even go to these types of events and rub shoulders with some of these brokers, they can maybe make some recommendations, right? But at the same time, I still would recommend you signing on somebody else's loan unless you know these people beforehand, which is why the relationship component of this is so uber important when it comes to signing on the loan. All right. I got a couple more questions in here that I wasn't necessarily going to do this, but all right, I'll go ahead and answer a couple more of these in here as well. All right. If they are getting 3% of the loan balance, when is that dispersed? So that is being dispersed, like I said just a few minutes ago, at closing when you sell the project. Not when you sell, when you buy the project, right? So if you're buying a project, that is almost it's the same thing as an acquisition fee. Typically, the acquisition fee is paid out to the GP when you close initially on the project, when you buy it. So that 1 to 3% guarantor fee will also be paid out at the closing table whenever you first acquire that property. Okay. Do you still provide mentorships in the Pit Club? So we have never really provided any mentorships. We have occasionally had some classes and some not really masterminds, but some master classes, if you will, where we would invite people into our offices, teach them about the various topics. But we're not doing that right now. We may do that down the road in the future some more, but right now we're not doing any of those. And like I said, just like with our book here, we didn't write our book to be able to sell you a bunch of classes or teach you or mentor you. That's not what we do. We are really good at apartment syndication, and that's what our core business is. We don't make money selling you coaching programs. We make money buying apartment complexes. That's what we do and managing that properly, right? And so that's what we're doing right now. That's what we've done from the very beginning, and that's what we're going to continue to do down the road. Now, you might be asking, well, then why are you doing these types of webinars? Well, these types of webinars we do because we know that there are people that are interested in apartment syndication and they have a little bit of money. And then when they realize, hey, you know what? This is a lot of work. There's a lot of risk here. There's a lot of benefits here. But you know what? I really don't want to do this anymore. I had a really good successful exit. I would rather you take my money and you invest it for me, and I'll just trust you to do it, right? And so for us, that's what we do. We teach and we guide and we direct, and we want people to read our book and be part of our network and really be able to say, hey, what can I do to invest with you? And that's what we're working on right now as well. We have 2 offerings right now available. We have our Alliance Fund that is available. And if you go to our website, passiveinvesting.com, under these current offerings, we have our Alliance Fund, which allows us to come alongside other operators that have deals that maybe need a little bit of capital right now. That's what that Alliance Fund is for. Projected returns are 20% plus. We also have our debt fund, our real estate debt fund. This allows you to park money in the debt fund for a short period of time or a long period of time and make between 6 to 8% on that money, and also have the ability to get that money out of the debt fund within a 90-day period if you choose to do that. We have about $85 million right now that's in that fund that we're constantly rotating and lending that out in our borrower facing front to that loan of that fund called Rehab Wallet. So right now we do have 2 funds available and 2 offerings available, and that's what we're focused on right now. We are not focused on trying to be mentors or coaches or anything like that. Do you have a deal analyzer that you can share or recommend here for us? So we do not have a deal analyzer that we actually have internally, but I would suggest that you look up Rob Beardsley. He actually wrote a book on underwriting. I was able to actually review that and actually write a testimonial or review in the book for it, which is really cool. But he has a great deal analyzer that I would suggest you looking him up and researching him. His name is Robert Beardsley. Rob Beardsley. So if you go to Amazon and you look up Robert Beardsley underwriting, you'll see his book there. And he also, I think, gives you access to be able to use his deal analyzer and maybe even on his website or something like that too. So you can certainly reach out to that. All right. As a way to turn the loan into a recourse, I don't know sure what that was for. Oh, how subjective are the bad boy carve outs? I have a friend that's mentor that won't be a guarantor due to the bank's exercise in the bad boy carve outs. They are very subjective, actually. So when it comes to these bad boy carve outs, they will try anything that they can to find a way to activate those bad boy carve outs when a deal goes south, right? A lot of times they won't really bring that up a lot in the beginning, when they first sign on the give you that loan. But if something happens to that deal, and you got to put yourself in their shoes, right? Wouldn't you try to find every reason possible to activate those bad boy carve outs if it allows you to be able to protect your downside with that loan? Sure. I mean, I would too, right? But you have to be very careful with those because they will try to find something. If you submit a personal financial statement or an SREO, a schedule of real estate owned, or a balance sheet that is not 100% accurate at that time frame, or on the date of that particular PFS, they could come back and say you fraudulently submitted a PFS or balance sheet or SREO, and now the bad boy carve outs are activated, right? If they feel like you misappropriated the use of the funds from that property, again, bad boy carve outs could be activated. So it is a really risky situation to be able to be in. That's why I say all loan guarantors usually want to have some form of relationship with their people first. All right. Well, that's all I have to say today. Go grab our book over on Amazon, Apartment Syndication, The Ultimate Guide for the Active or Passive Investor. Would love for you to grab a copy of that. Would love for you to be able to write a review on that for us. It would be really helpful for us. If you want to bring that book to the Best Ever Conference, I'll be happy to sign it for you as well. Danny won't be there, nor will Brandon, but I will be there and would love to be able to sign that book for you if you want to bring it along with you. And look forward to seeing you here next week. Let's see what the topic is for next week. The next week topic is preparing for property taxes, the correct way to underwrite the property tax expense. So we're going to have Chris Neary, our senior acquisitions associate, talking about that topic next week. So make sure you stay tuned and start registering for that. Just go to multifamilyinvestornation.com and register for next week's webinar. Thank you so much, and I hope you guys have a good rest of your day.